Hello there. Welcome to the Open right here on BNN Bloomberg. Happy Monday, one and all. That weekend takes so long to go. It's always too slow. Let's get to some other stories we're bringing you from the BNN Bloomberg newsroom. Canadian inflation rose to 2.4% year over year in December. However, the number was slightly distorted here because Ottawa eased taxes, you'll remember, at the end of 2024 on some items, including dining out and kids' toys. Those discounts then fell out of the annual comparison for December of 2025 and helped to push the consumer index higher. The European Union is weighing tariffs on $93 billion, or euros, of U.S. goods after U.S. President Donald Trump threatened new levies in the face-off over Greenland. Brussels has also frozen approval of a trade deal with the U.S. as it prepares for potential retaliation from Washington. Gold and silver surging to new record highs amid Trump's tariff threats and tension over Greenland. European stocks fell and U.S. shares are not trading today because of Martin Luther King Day, but futures, U.S. equity futures, dropped more than 1%. And let's have a look at how the TSX ended on Friday. It finished at a new record high, edging higher despite the geopolitical uncertainty. Let's have a look at oil this morning. And you can see the price of crude slipping below or further below that $60 US psychological mark. Another look at gold. We saw the spot price as well this morning, not far short of $4,700. There's a look at the February futures in record territory. And let's check out the loonie, the Canadian dollar. And you can see it is holding its own against the US currency, up about 0.25%. And finally, Bitcoin, the biggest cryptocurrency. And it is down almost 3%. We've seen pressure on stocks today after U.S. President Donald Trump threatened to slap a 10% extra tariff on imports from 8 European countries because they oppose having America take control of Greenland. Let's get more on this from Kevin Headland, Co-Chief Investment Strategist at Manulife Investments. Kevin, thank you very much for joining us this morning.
Thanks for having me.
I know, obviously, this is a moving, fast changing situation, but what broad guidelines can you offer here, or what's jumping out for you in the current investment landscape? I'm talking about Greenland right now and the tensions.
You know, when we look over the years, we're always going to see some geopolitical risk that happens throughout the year. Of course, this year, starting off quite heightened in geopolitical risk, creates some choppiness and volatility around the equity markets. This is where perhaps flight to quality makes a lot of sense, where you look at companies that are perhaps insulated a bit from geopolitical risk and globally, perhaps are insulated against tariffs. What you want to see here, gold has done well as a flight to safety. This could actually be positive tailwind for TSX equities, given how we have a large position in gold in the TSX. So when you look at geopolitical risk, I think it's an idea where we want to perhaps look at rebalancing our situation, not take undue risk, and understanding that these tend to be more disruptive than destructive over the longer term.
That's good. Disruptive rather than destructive. I like that. That's neat. So our market, the Toronto Stock Exchange, a total return of over 30% last year. But you notice it was relatively narrow. Gold, banks, and Shopify accounted for about 2/3 of the gain.
Correct. That's exactly what happened. We had banks rallying quite strongly, of course, gold and many materials as well. If you add the material sector as a total, you're up to close to 80% of the TSX was due to those three factors. There is potential for further support for the TSX higher. I just don't think we can achieve the same type of results. It'd be great if we got back-to-back 30+% returns. I don't think it's quite possible. That doesn't mean we are negative on the TSX. We're constructive. And I think banks could do well again, given some of the support metrics that the Bank of Canada put in over the last year to 18 months, going back to October's last rate cut. It tends to take about 12 to 18 months for rate policy changes to have an effect on the broad economy. So there is still some stimulus there. And then, of course, we have the budget and the federal government looking at further stimulating the economy, which also support banks. And gold is another one where we see continued legs higher. It doesn't go as high as it was last year, not necessarily. But again, I don't think there's any reason why gold should turn back, given the support metrics that were founded upon over the last year or so. Global governments and central banks redeploying their assets or diversifying their assets from the U.S. dollar towards gold, as well as, again, the flight to safety, geopolitical risk helps gold as well. So there are definitely support metrics for underlying TSX moves higher this year.
It doesn't look like there were any big surprises on the inflation front today. The number was distorted by those tax breaks that the federal government gave us on kids' toys and alcohol and stuff at the end of 2024. What is your read? Do you think the Bank of Canada is it conceivable they'd cut again in the near future?
The point you talk about, the distortion, is the big point, because if you look just at the numbers, you'd say, oh, inflation is stickier. Perhaps the Bank of Canada is looking at raising rates to combat inflation. We don't think that's the case at all. That distortion is important to understand the base effects. We have to understand that it's not just about the headlines, understanding why those numbers moved. So that's important from there. I don't think the bank can necessarily cuts rates this year unless we get a surprise here. It's not about inflation. It'd be more about an economic weakness, unemployment shock, something there where the bank kind of feels they need to cut rates to stimulate the economy. They're at neutral right now. I think they're quite happy where they are. Inflation's coming down towards their target. If you look at some of the other measures they look at, it's actually below their target of 2%. So they're quite happy where they are now. It'd be more about a reaction to a negative economic shock, more so than an inflation story right now.
Are you interested in energy? What you and your colleagues, are you overweight, underweight, or what are you doing about oil and gas stocks?
Right now, oil and gas, of course, you look across it there, you're going to be investing in the pipelines, energy producers. Where on the oil and gas do you want to look at? Valuation as a sector basis is actually not as attractive as many might think. It is fairly valued on a trailing P basis and a forward P basis. Of course, oil is stuck at that $60 level, as you mentioned earlier. That is, somewhere where Canadian energy producers would love to see oil a bit higher. There's still, of course, some uncertainty around tariffs and Venezuela oil and how that fits with demand for oil in the future. So it's one where we're looking at very closely, understanding the individual companies and how we might be able to take advantage. But it's not something where we just want to say we're bullish on the energy sector just yet. It's more about picking our spots and taking advantage of where we can.
When you talk to your colleagues and those who or client-facing, to use the jargon, frontline advisors, et cetera, what are they hearing from your customers, from investors?
I think investors are quite happy. Of course, you look at open their statements now from 2025, very strong returns. Of course, many have said we're not going to be able to repeat the U.S. equity market returns we had in the previous 2 years. This year was kind of a handoff to the TSX as well as international stocks. So I think there's a lot of excitement around their investments right now. We are being cautioning that perhaps this is a great year to just dial back the risk a little bit, understand that this is a very strong market, but strong markets don't always continue at the same degree. But look at the risks as well. People are calling a bubble in AI. We don't necessarily see that, but perhaps we want to be a bit more risk controlled or risk managed right now in our investments.
And AI, broadly speaking, are you wary of a sell-off, perhaps sparked by OpenAI, for example, running into a debt crisis?
I think it's really important to understand the individual companies in AI and look at their earnings announcements this year, as well as their guidance. Spending was materially higher last year in AI. You saw a couple of companies that rallied on the announcement of spending and then pulled back afterwards. So it's important to understand the individual companies here. AI is likely a long-term here to stay. the type of enhancements and productivity enhancements that we're seeing from AI is really important. But understanding that those businesses are spending and perhaps too much on debt, that could be an issue longer term. Short term, not necessarily an issue, but it's definitely something to watch out to make sure that those companies are growing as a result of their spending, growing the revenue, growing the earnings. It's not just about a debt spiral, shall we say.
We'd better jump. Kevin, thank you very much indeed for kicking off the show this Monday. Stay warm. Kevin Hedlund, Co-Chief Investment Strategist at Manulife Investments. Coming up, we're going to get more on the fallout from U.S. President Donald Trump intensifying his pursuit of Greenland. Investors are jumpy after U.S. President Donald Trump escalated his pursuit of Greenland. We've now got tariff threats against European allies or trade partners. This has sparked emergency meetings in Europe. CTV's Jeremy Sharon has the latest.
It is this massive Arctic island U.S. President Donald Trump insists the U.S. needs to own. But Trump's push to punish allies in his quest to take over Greenland is being met with trepidation.
It's a serious situation, and we're concerned. We're concerned about this escalation, to be absolutely clear.
Prime Minister Mark Carney defended Greenland's sovereignty and security today, insisting Canada's position hasn't changed.
The future of Greenland, decisions about the future of Greenland, are for Greenland and Denmark to decide.
In a Saturday night social media post, Trump threatened tariffs on 8 countries until a deal is reached for the complete and total purchase of Greenland. Sparking today an emergency meeting of European Union ambassadors in Brussels, a joint statement by the 8 countries says tariff threats undermine transatlantic relations and risk a dangerous downward spiral. We will continue to stand united and coordinated in our response. We are committed to upholding our sovereignty. Trump's threats could be a potentially dangerous test of the U.S.'s partnerships with European allies.
It runs the very real risk of doing lasting damage to the NATO alliance, to the cohesion that is so important.
Trump's Treasury Secretary repeating today in an interview with NBC's Meet the Press that owning Greenland is essential to U.S. national security.
Peace through strength, make it part of the United States, and there will not be a conflict because the United States right now, we are the hottest country in the world. We are the strongest country in the world. The Europeans project weakness. The U.S. projects strength.
Denmark continues to pursue a diplomatic way forward with the U.S. over Greenland and is meeting with fellow NATO members to discuss the alliance's Arctic security strategy. Jeremy Sharon, CTV News, Ottawa.
On Friday, on Market Call, we were joined by Andrei Omelchuk, CEO and Chief Investment Officer at Lineguard Capital Management. His focus, North American small and mid caps. His top ideas were Bird Construction, Trisura Group, and Electrovaya. Today on the show, it's Christine Poole, Co-Chief Investment Officer at Davis Ray. Her focus, North American large caps. Up next, why Canada could actually be a winner from U.S. President Donald Trump's exempting critical minerals from tariffs. We'll be right back. Washington is exempting critical minerals from tariffs. It's a move that could give Canada some future leverage. CTV's Judy Trinh filed this report.
Tariff is my favorite word in the whole dictionary.
The U.S. president wields tariffs as a weapon to boost domestic production, but Donald Trump is choosing not to impose tariffs on imports of critical minerals he deems essential to the national security of the United States.
The problem you have with putting tariffs on critical minerals is that you will get less of them.
In Trump's proclamation, he acknowledges that the U.S. is 100% reliant on other countries to supply 12 critical minerals and 50% reliant for another 29. The U.S. needs access to lithium, copper, cobalt, and others to build its military weapons. It wants to reduce reliance on China for the processed elements, but the U.S. doesn't manufacture enough to meet its needs. So the Trump administration says it will negotiate with G7 countries and other allies to set a base price for minerals to ensure a stable supply chain.
Without a floor price, you won't be able to get these projects financed. So without a price that the government is willing to pay, parties aren't going to sign up to provide them. So they're not willing to build the plants that will produce the output if they don't know what they're going to be able to sell them for.
Canada has the critical minerals the U.S. needs. There are currently 56 mines, 26 processing facilities, along with 151 projects waiting for development. Negotiating a floor price could get minerals out of the ground faster. It could also give Canada leverage in trade negotiations with Trump, because China also needs the elements to fuel its transition to clean energy.
What we heard loud and clear is China is looking for reliable trading partners that don't use energy for coercion.
Hammering out an agreement on critical minerals will be separate from negotiating the Canada-US-Mexico trade agreement, which comes up for review in July. Judy Trin, CTV News, Ottawa.
Let's take a quick look at how stocks have been trading around the world. We'll start off with Asian markets, and you can see the Nikkei down, the Hang Seng down, but China's big stock index holding its own. But we have seen a broad sell-off in global stocks. As I mentioned at the top, U.S. stock market futures lower today. Their markets, though, closed for actual trading because of Martin Luther King Day. The dollar also, U.S. dollar also down. Can we maybe have a look at the U.S. dollar? There was some move into the safe haven Japanese yen and Swiss franc with this confrontation between the U.S. and the Europeans. And as I mentioned earlier, gold and silver jumping to new record highs. Oil slipping because thanks to control room. Oil slipping. Didn't get a very long look at the U.S. dollar there, but it has come under pressure. Oil down because, of course, if there is an escalated trade war here between the Europeans and the Americans, it's not going to be good for energy demand. There's oil. Look at that, off 24% in the past year. Let's have a look now at European stocks because the Europeans are weighing their own response to Trump's tariff threat. The plan Trump has announced, or the latest I've seen, is that they'd start at 10% on February 1st and rise to 25% on June 1st. These would be tariffs on 8 European allies if the Europeans, or if some kind of a deal is not struck, allowing the U.S. to buy the territory. It's an autonomous territory of Greenland with some powers of self-government, but Denmark retains a lot of authority over foreign relations and stuff like that. Now, there's talk that the Europeans might go with what people are calling a bazooka on the trade front. That would be massive set of trade measures, and the Europeans, apparently their strongest economic countermeasure is known as the anti-coercion instrument. And it is, as I say, described informally as the big bazooka against potential extra U.S. tariffs. And it's never actually been used before. We're hearing reports, though, as I mentioned off the top, that the European Union is thinking about more tariffs on more than 90 billion euros worth of goods. So you can see pressure on European stocks, especially the French stocks. Oh yeah, the French are said to be among the most aggressive advocates here of a vigorous response to Trump. Let's see where U.S. futures are today. We saw them down more than 1% earlier. Yes, look at that. And the NASDAQ down about almost 2%. Of course, that'll be reflected in actual trading on Tuesday when the U.S. markets reopen. Let's see what the TSX did on where the TSX landed on a Friday. And yep. Yeah, I'm not sure. That's not agreeing with what my screen is showing. My screen does show that the TSX ended above 30,000 on Friday. There's a look at some movers on Friday. Brookfield Business up more than 12%. BlackBerry also saw a gain. Curaleaf, the cannabis stock, down, and Aya, gold and silver, losing some altitude. Let's have a look at bond yields right now, including U.S. bond yields. If there is a sell-off in the U.S. dollar, it's likely that that's going to translate into weakness in U.S. bonds if investors are selling. Oh, we're not getting any movement in U.S. bonds right now. Their bond market is closed, but I thought it might be trading regardless of that. And there is a look, though, at the U.S. bond yield over the past year. We are going to take a break. We've got the opening bells next. We'll be getting to those opening bells, or the opening bell in Toronto shortly, because remember, U.S. markets closed for Martin Luther King Day. We do have some intriguing earnings coming up. We corrected that board. That's how the TSX ended on Friday at a new record closing high. I want to tell you about some interesting earnings, though, this week. We are expecting to hear from Netflix and 3M tomorrow, Halliburton also this week on Wednesday, and J&J Wednesday, and Procter & Gamble, the classic defensive stock, U.S. consumer products giant. That is due on Thursday. Maybe we could put up a 5-year chart for PG in New York. I'm just curious to see how I think it's PG, how that stock is done. Of course, you hope that it's a steady grower, but there's always a problem in a slowing economy, or when people are not feeling wealthy, they may be tempted to go for cheaper store brand products. Now, I'm not sure if that's been happening with Procter & Gamble, but that's why that company is such a heavy TV advertiser and has been for decades, to try to put a glow around its brands and have people reach for them rather than the cheaper generic alternative. And you can see the stock has been drifting down over the past year. Okay, we're going to have a relatively quiet day today with U.S. markets open, but that's good. In fact, it gives us more time to pay attention to Canadian investment stories. Here are the opening bells. It's Global X Investments Canada doing the honors today. It's time for the first 50. Oh, I see our own John Ehrlichman is there. Nice. Okay, let's have a look at how the TSX is opening this morning. Remember, it did end at a record high on Friday after its gangbusters year last year with a return of more than 30%. And perhaps not surprisingly, it is wavering a little in early trading. However, it's probably going to be getting support today from precious metals hitting yet another high, just unstoppable. And of course, the Canadian or the TSX index of gold stocks has also been climbing to a record highs. Now, we got inflation rising in December, but as mentioned, it was distorted by the federal government's goodies that it threw to voters and taxpayers at the end of 2024 with the emission of sales tax on some items. And that, of course, artificially depressed prices in December of 2024. Let's see. Let's just have a look at some of the big gold stocks here. Maybe we can put up AEM. I wouldn't be surprised if it's trading in record territory once again. Maybe we could have a look at ABX. Look at that, Agnico Eagle. Like so many other precious metals producers, going vertical in the past couple of weeks. Let's have a look at ABX, see how that's trading. And also maybe WPM, which is Wheaton Precious Metals. It does offer you a play partially on silver. There you go. And that one has been hitting record after record. Really incredible. Gold, the gold enthusiasts, the gold bugs, as we love to call them, have been vindicated over the past while. But do remember that post-2011, when gold went to a record high, it was dead money for pretty close to a decade. It didn't get back to those 2011 highs for, I think it was more than 7 years, and it might even have been more than 8 years. A couple of other stocks that we're watching this morning. Gold's Natra B2 Gold is up about 3%. That has been something of a laggard. Okay, maybe we can put up Denison Mines, DML. It, along with uranium stocks, other uranium stocks, surged last week, down slightly in early trading. Cameco, CCO, maybe you could have a look at that. That one also hitting a record high last week, losing a little bit of altitude today. The big percentage gainers, though, naturally dominated by the gold stocks. Incredible. IM Gold, I think it's IMG, up about 7% in early trading. Oceana Gold up something like 4%. Oh, one other stock we're watching, I nearly forgot, is Mullen Group. Mullen Group coming up with what Desjardins says were a stronger than expected 2026 outlook, and also preliminary results for 2025. Stronger than expected targets for 2026, according to Desjardins. Management is targeting consolidated revenue of up to $2.4 billion, which is well above consensus of about $2.2 billion. But in a drifting market this morning, Mullen Group shares not doing much. Okay, let's get a look at what investors are watching south of the border and internationally. We're joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. We touched on this already, Jeff, but hardly surprisingly, in Europe, stocks exposed to extra tariffs from the US under pressure today.
Yeah, they're under a lot of pressure. This is the outcome of the events over the weekend where U.S. President Donald Trump said that he was going to impose additional tariffs on 8 countries that are, standing in the way of his hope to annex Greenland or take Greenland. So those countries include, obviously, Denmark, Norway, Sweden, France, Germany, the UK, the Netherlands, and Finland, all getting extra tariffs this morning. But the stocks that are worth watching here are not only varied, but the stocks are down quite sharply. BMW, Volkswagen, Mercedes down 4%, 3% over the course of the trading day, as well as the luxury good makers like Christian Dior, also down sharply. But it's not just those kind of trade-exposed sectors. You look at the overall market in Europe, you see a lot of red so far this morning at the index level. That includes the Euro Stoxx 50 index, the DAX, the FTSE 100. All of these are down this morning, worth watching. Perhaps also maybe giving us a little bit of a preview of what might be coming tomorrow in the United States. Of course, cash trading is closed today because of the Martin Luther King holiday in the U.S. So we are not seeing stocks trade this morning, but futures is certainly something we're watching as well.
And let's have a look at gold again, because sign of investor nervousness, precious metals hitting new records.
Precious metals are hitting new records, and the futures in the U.S. are trending lower. So this is not only a European phenomenon. We are seeing futures on the S&P 500 down about 1.1% so far this morning, and on the NASDAQ down as much as 1.5%. That is a huge move. Those are great big moves. If we do see that materialize in in the cash trading market, which will be open tomorrow morning, it's certainly worth watching. These, as I mentioned, are big moves lower, not only in Europe, but also in the United States, and things to watch tomorrow. As you rightly pointed out, precious metals prices are moving higher this morning in reaction to those headlines over the weekend and the kind of rising geopolitical tensions and pressure that we're seeing.
The Financial Times is trying to parse remarks by the UK Prime Minister, Keir Starmer, because of course Britain is America's #1 military ally, and certainly in terms of support they've provided in wars over the past few decades. The Prime Minister, according to the Financial Times, signalling Britain is not keen to impose unilateral tariffs because, of course, they'd be excluded from the EU response. The Prime Minister also, according to the FT, suggesting that he thinks Trump isn't serious about his threat to actually invade Greenland. He says this should be resolved through calm discussion. Yeah, calm discussion. I like that, as opposed to thumping the table. But it's a tricky one for Britain.
It's a tricky one for Britain, and as you mentioned, they have the opportunity to impose their own tariffs, counter tariffs, if they so choose. The speech from the Prime Minister, Starmer, was about 11 minutes long, and definitely worth watching, kind of interesting in trying to lower the temperature, I suppose. We're seeing a lot of commentary out of Europe. Obviously, there's a lot of tension there with letters sent back and forth between the Prime Minister of Norway as well. So what happens here is going to be an interesting week going forward. Having said that, the UK stock market is not so far immune to this move lower, even if the UK does not impose its own counter tariffs on the US. The FTSE 100 is down 0.4% so far today. That on its own is a pretty decent drop. Again, not as much as the contracts on the S&P 500 so far.
And the president apparently miffed that he didn't win the Nobel Peace Prize, and he told the Prime Minister of Norway, considering your country decided not to give me the Nobel Peace Prize, and I don't know if that's a Norwegian government decision, it's the Nobel panel, I no longer feel an obligation to think purely of peace. But maybe just a throwaway remark by the president.
Yeah, that was the reported in a handful of European papers this morning, and apparently a letter sent from Trump to the Prime Minister of Norway over the weekend. Certainly, alarming things written down on the page.
Thank you very much, Jeff. Jeff Morgan, our colleague and partner at Bloomberg. Coming up, we're going to get more on the TSX, which hit a record high last week and slipped in early trading this morning. A lot going on. There are reports from Bloomberg and other sources that the Prime Minister, Mr. Carney, is considering a token military mission to Greenland, ostensibly to take part in NATO maneuvers. But it's other European countries have done it already, or said they will, as a gesture against Trump's acquisitive noises about that Danish territory. Okay, let's get more from one of our favorite guys. He's skeptical, he's incisive. Jim Thorne, Chief Market Strategist at Wellington Altus Private Wealth. Thanks for joining us, Jim.
Good morning. How you doing?
Very good. I mean, it's somber stuff, this, isn't it? I mean, just incredible remarks by a U.S. president.
Andy, the Americans have been talking about taking over Greenland for a century. This is not new. Now that Trump talks about it, everybody's freaking out. Look, Greenland is not part of Europe. It's not a member of the EU. I don't know why everybody's weighing in. I don't know why Prime Minister Carney is going to send, 10 guys, right, for a weekend jaunt. There has been a precedent about, look, I mean, the British Virgin Islands were purchased by the Americans during the First World War because they were worried about Germany getting the Panama Canal. Because of climate change, right? We've got open shipping lanes in the Arctic. President Trump has made it very clear in the Trump doctrine that he's not going to outsource national security. And I would suggest that there is a deal that's going to be made. And I think that Europe, I'll put it generally, the people that are being targeted are making a tactical mistake in pushing back.
And not what? Just deferring, genuflecting to Trump? I mean, this is Putin, Vladimir Putin type stuff, saying, I want a territory and I'm going to get it.
As the Prime Minister said in China aptly, we are in a new world order.
Where we have to give in to bullies?
No. Greenland is a colony, and let's let the folks of Greenland make the decision, not Macron, not Stammer, and not the head of Germany. So all I'm trying to say is there's a lot of noise going on. There is a precedence there, right? I mean, Louisiana Purchase, Alaska.
Sure.
There's been a lot of presidents that have talked about it. And so let's see where this lands, but it would be up to the citizens of Greenland to make the deal, not Brussels.
That's an interesting point. The people of Greenland, of course, have expressed their opposition.
Let's see what happens. That's all. That's what I'm trying to say. I just think there's too much performative politics and virtue signaling from people that should not get involved. And I think we need to take, even Chatham House is taking it. We need to understand that we are in a new era, right? And Mr. Trump and his team have been very transparent over the last couple of years of what he's thinking. Yes, this is power politics. This is realpolitik, as we would call it. This is not the rules-based orders since post-World War II. Prime Minister Carney has alluded to it, right? So I don't understand what 10 guys in a tank for Canada are going to do in Greenland.
It's symbolic.
It's symbolic, but we don't need to get in. I don't think we need to get involved. I will put it that way.
Don't we need to stand with a NATO ally, aka Denmark?
It's not about Denmark. There are no documents that clearly cede Greenland to Denmark. So we need to understand that if you go through and look at this historically, a lot of the premises that people are assuming exist are false. So it's a colony. It's in North America. They declined to become a member of EU. They have not been treated well. Of course, there's critical minerals. So I would just suggest that the president's move is not that provocative. It's very thoughtful. And I think folks need to really start to think through this. I'm not saying, is this based on the rules-based order of post-World War II? No. But Andy, this is the Trump doctrine. As the Prime Minister says, you don't have to like this, but this is the rules that we're playing in, and play your cards accordingly.
Okay, we'll have to. Yeah, we don't want to get bogged down on that. So, how are you playing the TSX right now? Are any sectors overvalued, inflated right now, Jim?
We were talking earlier, it's gold fever, Andy.
Yes.
Buckle up, right?
Yeah.
We had the generational trade in gold and silver that you and I have been waiting for all of our career. So
let's have a look at, sorry, Jim, a 20-year chart for gold if we have it. Carry on, please.
Yeah. Look, 20% of the TSX is materials, and it's gold. I think that's 16% is gold, 1% is silver. As we have talked about since I've known you, it's a core holding in everybody's portfolio.
Or should be, you reckon?
But it's, as a technical, when you look at it, when charts start to go parabolic, irrespective, is it AI, is it uranium, is it banks, whatever, parabolic charts need to digest the move, and typically what happens in that digestion period, there's a couple of months of really sharp drawdowns to shake out all the tourists. So I like it long term. We're in a seasonally strong period. I would make sure your portfolio has significant exposure to gold and silver and material. So that is the foundation and the anchor for the TSX, yes.
I mean, can you generalize? People vary, I know, but what kind of minimum weighting would you be looking at?
I've been saying 10%. But I said 10% before the move.
Okay.
Right. And, and silver, the thing I worry about with silver is the fact that it's really important for industrial production. Right. They've been increasing the margin requirements. But Andy, I think what we're going to see is I think we need to accept the fact or prepare for the fact that Xi and Trump are going to reach a grand bargain in April. And how do the precious metals work with that? Right?
Yeah, I'm sorry, John. We have a wrong banner there because, of course, the S&P 500 reached a record high early last week.
Yes.
And futures are down today, so we're not back at that level. But the TSX hit a record high on Friday, as you know.
Sure.
Sorry, Jim, I cut you off there.
Sure. 8,000 on the S&P. TSX is going to, this year, TSX is going to be fine. I just don't think we're going to have a year like we did last year with gold and silver. And Andy, let's be honest. Month over month, CPI just came out and we saw deflation. Look,
it's interesting on month on month.
Month on month, and year over year uptick, but we're lapping the GST and HST
holiday on kids' toys and stuff.
Right, for last year. So you put that out, and then if you go underneath and you look at the labor data, right, underneath the headline, the public sector is crowding out the private sector. So we still have a Trudeau-Friedland economy. And my problem or my criticism of the Prime Minister is he is pragmatic globally, but domestically he's playing performative politics and virtue signaling. He has the constitutional right to build pipelines and to stop the ban on tankers off the West Coast. Andy, do you really think that meeting with groups between now and the fall is going to change their point of view? There is going to be consternation on both sides of the ball when a decision is made. And my point is, he has the right to make the decision now. He needs to make that decision, and we need to get on with it. He needs to attack, and I said this, and I'm going to say it in a bit. He understands, and he knows if you listen to his speeches, that the regulatory environment and the inertia within the bureaucracy of Ottawa is going to make structural adjustment very slow. But Andy, we live in a world where generational stuff by Trump is moving week by week. I mean, Trump doesn't take a weekend off. So I think he's making a mistake by not using his constitutional rights more and be much more forceful and pragmatic domestically as he is internationally.
Yeah, of course, he's a bureaucrat. He was senior in the Department of Finance. He ran 2 central banks. He's a creature of the system.
But but also he's Goldman Sachs.
Yeah, and
Brookfield. And he's in Brookfield.
Yeah,
so he's Dr. Jekyll, Mr. Hyde, right?
Jim, thanks very much indeed.
Thanks, Andy.
Jim Thorne, Chief Market Strategist at Wellington Altus Private Wealth. Up next, we're going to hear how this year's World Economic Forum in Davos is grappling with that new global order that Jim just referred to. We'll be right back. The Prime Minister is in Davos, Switzerland today to attend the World Economic Forum. And of course, tariffs and geopolitical tensions will be on the agenda at this year's summit. Let's get more from CTV's Rachel Aiello. Rachel.
Yeah, good morning. So the Prime Minister is actually set to arrive in Switzerland around 10:30 Eastern today, but it's late in the afternoon Switzerland time. So we're not expecting any events for the Prime Minister this afternoon, though he will be preparing for a pretty big day tomorrow. The Prime Minister is set to deliver what they're calling a special address at the World Economic Forum, talking about how to collaborate in a more contested world, which really I think is a pressing conversation to be having right now. As you rightly were just discussing, the concerns across the world about U.S. President Donald Trump's ratcheting up of threats of tariffs and his desire to essentially buy Greenland. So while that is not officially the agenda item the Prime Minister was heading to the World Economic Forum to discuss, obviously his focus was intending to be selling Canada to the world, to other world leaders, but also all of those wealthy investors who are going to be in Davos. Really what is becoming the pressing conversation here is a geopolitical one that we expect the Prime Minister to be navigating over the next few days.
And this question of him possibly sending a token number of troops to Greenland, that's a tricky issue for Canada.
Certainly. So what we can say right now is, according to a senior government source, the Canadian government is considering sending a small number of soldiers to Greenland. Our understanding would be that they would be participating in training missions alongside the other European soldiers that have been sent or will be sent over the next little while. As you rightly point out, largely a symbolic move, but of consequence, potentially, if U.S. President Donald Trump gets word that Canada is joining these European countries in putting up any form of military presence there, would that mean Canada gets hit with more tariffs, as Trump has threatened to those 8 European countries? So all of these are high-stakes conversations, considerations that Canadian officials are continuing to have. We're told at this point no final decision has been made if Canada is going to send soldiers to Greenland.
Thank you very much, Rachel. CTV's Rachel Aiello. Tech has been on a ride this year. Let's bring in BNN Bloomberg contributor John Ehrlichman with more on the volatility we've seen in 2026. John, what's the buzz on tech right now?
Well, it's been fascinating, Andy, because AI remains at the center of this story. On the one hand, we have a chance to breathe with a slower day south of the border today. You have had investors doubling down on the companies that are providing everything that powers the AI engines right now. Memory, the shortages that companies are grappling with has really fueled demand for those stocks. But something we've talked about before, Andy, the fact that there's worry that AI takes away from certain tech players, namely software, has taken a bite out of some of those companies. So that's the disconnect we seem to have in the market right now, creating some of the volatility.
What catalyst should we watch from here, John?
It seems like earnings obviously is the one we're tracking this week. You start to get into some of those better tech flavors. Netflix, not really a company at the center of the AI boom, but you mentioned obviously we'll be watching them closely. I do think Taiwan Semi was a great example of what kind of messages we'll be getting from the AI players. But perhaps just as important is the continued commitment to spending by big companies in technology on AI to keep the hottest plays alive. And then in terms of these software companies that are trying to prove their case for healthy businesses that actually integrate AI, I think the ball is going to be in their court to paint a picture based on numbers that their businesses are doing fine, thank you very much, and that's worth watching.
John, I saw you were helping Global X open the market today. I know they were the original sponsor of Ticker Take on YouTube. What was the event today? Was it just general festivities?
You know what's interesting about this? This is a new ETF that is tied to copper, Andy, which you've talked extensively about the all-time highs based on AI and the demand there, but it's a covered call copper ETF. So this is actually something that the market was quite interested in. People are interested in these trend areas. Sometimes they don't like as much volatility, and there's been a real income orientation that we have seen in ETFs in Canada. So covered calls as a strategy is a massive growth story for ETFs in this country. And then the copper part was based on some client demand. So it's been a very popular ETF.
Thanks very much indeed, John.
Thanks, Andy.
John Ehrlichman. We're going to take a break. Up next, the latest headlines and another look at the TSX. Welcome to the second hour of The Open. Let's check out the big stories we're bringing you from our newsroom. Canadian inflation accelerated more than expected in December when you look at the year-over-year number. Data from StatsCan indicates that the consumer price index was 2.4% higher than the same period a year ago. However, a tax holiday at the end of 2024 is distorting the reading because, of course, a year ago, that tended to push prices lower. In the latest numbers, broader food prices were up more than 6% year over year. That was the biggest rise since 2023. The gasoline prices, however, were down. The European Union is in talks to potentially impose tariffs on tens of billions of dollars worth of U.S. goods if U.S. President Donald Trump follows through on his threat to hit European countries with a 10% tariff if they object to America taking over Greenland. According to Bloomberg, the EU is weighing additional countermeasures beyond tariffs, with leaders set to hold a meeting later this week. Brussels has also frozen approval of a U.S. trade deal. Shares in Keyera down about 3% today. The Canadian oil and gas processor and storage company says it shut down its Alberta EnviroFuels facility due to the failure of a key component. And that outage is expected to continue until May. Keyera now expects its liquid infrastructure segment to face a $50 million profit margin impact, and the company has revised its outlook for the year. TSX down about 0.1% in early trading after hitting a record high on a Friday. The European Union is in talks to potentially impose tariffs on tens of billions of dollars worth of U.S. goods if President Trump follows through on his threat to hit European countries with a 10% levy if they oppose his takeover of Greenland. Let's get more on this from Barry Schwartz, Chief Investment Officer and Portfolio Manager at Baskin Wealth Management. Barry, thank you very much indeed for joining us. Uncertain times, what do you make of this from an investment point of view, this face-off over Greenland?
I'm going to start with a bad joke, but I'm going to have tacos for lunch, and I hope that will be the case with this round of tariffs. You know, the bottom line, Andy, is every one of these threats has been a buying opportunity for the S&P 500, right? It's just, can you withstand the day-to-day volatility and the nonsense that comes with it? But no question, we're glad the U.S. market is closed today because it probably would have been a very terrible open. As for the TSX, you know, nothing can stop it, right? Because the Toronto Silver and Gold Exchange seems to want to go up every single day because we get more uncertain and nasty headlines every single day. So, you know, I am worried at some point. This looks to me like what happened a few years ago with the marijuana stocks, where everybody needs to buy the same stocks and they're just going up because they're going up. And at some point in time, I think people are going to get their heads handed to them in this gold and silver trade because it's not that easy. Investing is not that easy. You can't just buy a commodity and think it's going to go up every single day for the rest of your life. And so eventually some sanity will return to these markets. But this is the year we started off with. It's been wild already. What are we? Only 19 days into the year.
That's interesting, though, your thesis that Trump makes threats and then your taco references Trump always chickens out. People say that he backs down. Of course, that's his style, perhaps makes threats up front as an aggressive bargaining position. So that's interesting that you can, in theory, ride this stuff out if cooler heads prevail on the tariff front.
Well, you raise a good point, and the question is, why can we ride this stuff out? And the reason we can is, look what happened last year. Corporate earnings were incredibly strong. We had double-digit earnings growth in the S&P 500. We had a terrific catch-up for a lot of underperformers in the Toronto Stock Exchange last year. And the rationale is interest rates are headed lower, inflation, you know, even that Canadian number today is kind of misleading, as you pointed out, because of the handout of the lower GST that happened in 2024. Probably we should have got a lower GST in 2025. It's not like things are that much better this year or 2026. But the bottom line for us is it's all about corporate earnings, and the expectation for the S&P 500 as we head into 2026 is double-digit profit growth, as well as double-digit profit growth heading into 2027. So it's hard to fight that tape. It's also hard to fight a Federal Reserve that's in lowering interest rates mode, especially because of the tamer inflation that we're seeing and the weakness in the job market. So all these things put together should lead to a nicer corporate profit outlook, and over time, stocks follow earnings, as we all know.
Speaking of stocks that have gone up a lot, what about the good old banks, Barry? Are you seeing value there, or are they getting pricey?
They are pricey, but I think they, as we all know, they were priced for calamitous times to happen as we came out of 2022, 2023, right? Interest rates got up so much. Everybody was worried about the Canadian economy, how it's going to relate to higher interest rates. And if they don't cut those interest rates, there's going to be defaults on mortgages. I mean, we're still kind of seeing it, Andy, in the real estate market. As you know, condos aren't selling. Houses, depends what area. We're seeing so many of these private real estate companies gating redemptions, and so times are not exciting for developers, and in fact the opposite. So we're still on a tightrope in terms of a bunch of parts of the economy. On the other hand, we have to feel good about what our Prime Minister Mark Carney is doing, signing trade deals, trying to open up relationships more with China. These are good things for Canada as we hope to reduce our dependence on the United States.
And what about the copper party? Maybe you can have a look at copper. I'm not sure. I think copper is trading today, even though U.S. equity and bond markets are closed. I'm not 100% sure. But copper at record highs too.
Well, here's the thing. We're back to the super cycle that we had, in the early 2000s. We all remember how badly it ended when potash was the world's biggest company. Teck Resources was going to go straight to the moon. These things, people forget that commodities are the most boom bust type of industry to be in. Why is copper at these levels? We're all so excited about the electrification of the grid, this AI demand, the fact that even with all this trade and tariff uncertainty, the economy around the world is still growing. And copper's not easy to find or get out of the ground. That being said, prices can reverse. That move since, you're looking at that chart, that move since the middle of 25, straight up parabolic, that does not make sense to me. That should not how that's not how things should be going in terms of commodity prices. It obviously can go on for as longer than people expect, but at some point, people are going to be overpaying for a bunch of these commodities, and if the economy starts to slow down, if that's the case, you don't want to be overweight commodities. So I think the TSX, brilliant year in 2025. Sure, I'm super jealous, but I'm not at all tempted to buy any of these commodity names at all-time high prices. It's just ludicrous.
Why do you say super jealous, Barry?
Well, because there was a great return on the Toronto stock market last year, close to 30%, and no one who didn't own any commodities in size, gold, silver, you name it, did not catch up at all to the Toronto Stock Exchange. But if you look for many, many years, the Toronto stock market completely underperformed quality U.S. stocks for a number of years. But nothing grows to the sky. So you can say that about quality stocks too. They probably had their day in the sun a few years ago and have to cool off. We're in the commodity super cycle right now, where everybody's so excited and pricing uranium as if we're going to be building nuclear power plants everywhere. But the valuations are way, way ahead of themselves, in our opinion.
Apparently these plants there's no plants under construction in America right now, and even if some are approved, they won't be going until the 2030s.
People cannot do math in the short term. We get excited about the fear of missing out, and I get it. And we've seen parabolic moves over the years in so many different commodity prices, whether or different sectors, throughout history. It always ends up poorly. It doesn't mean that we're not going to be using these things. It doesn't mean that there's not demand for these things. It just means sometimes we totally get ahead of ourselves and price in commodities. People need to understand how volatile commodity prices are. And, when they're working in your favor, you feel like you can't lose. You're a genius, but it can go against you really, really quickly because demand can turn on a dime.
Barry, always great to hear from you. Thank you very much. Barry Schwartz.
Stay safe out there.
Thanks, Chief Investment Officer and Portfolio Manager at Baskin Wealth Management. Coming up after this, we'll take a look at why Canada has been losing out when it comes to tech talent. We'll be right back. Gen Z tech entrepreneurs face challenges in starting their businesses in Canada. We heard one tech startup who moved her business from Canada to the US. She gave up on this country. We were joined by Mai Trin, founder of Internet Backyard.
What we do is that we automate the entire circle from quote to cash for data center, co-location, and neo cloud, which is obviously very huge right now considering the demand for AI.
And let's talk about Red Thread as well, a community Gen Z startup for tech founders. Give us a sense of why this was needed, do you think?
Yeah, so I started this in the beginning of summer when I just graduated and looking for jobs, and I feel like I don't want a traditional jobs. So I start going to all the conferences and realizing that there's not really a space for Gen Z in entrepreneurship in Canada. So I posted a TikTok video, talk about how I want to create my own community and surround it with like-minded people. It blew up, and over 60 days, we got over 1 million impressions across media, and we have around 3,000 people in our community.
It's amazing. I'm curious, though. I mean, you felt you needed to, you started your tech journey in Canada and then you left Canada. Can you explain why you felt you needed to leave Canada to really get this business going?
Yeah, so there's two main reasons. Number one is visa. So I'm an international student. I'm from Vietnam and my co-founder is from Brazil. For us to be able to get PR in Canada, we need to work on someone else's company for 2 years in order to qualify for enough score. And because the score keeps rising, we can't really do so while building our company. At the same time, the startup visa program in Canada is a 10 years wait time. It just doesn't work for us. And the second reason is that we were told that because we're building a fintech company, the infrastructure that you would need in order to launch quickly and scale successfully, it's only available in the state and not in Canada.
So when you think about really the decisions, it came back to government policy in some capacity, whether it's open banking in the case of the fintech, and the other part is basically a deprioritization of entrepreneurship in the Canadian economy. Are there quick wins you see from the policy perspective that could really help bring that forward? I think we'd all agree that open banking is a huge win for all of us, but we will be waiting another few years before that happens. But is there anything on the entrepreneurship side that is low-hanging fruit for Canadians?
Yes. So we see that there's a pool of talent that just in two hub spots. So you have Vancouver in the West Coast, and then you have Toronto in the East Coast. Majority, 83% of Canadian students after graduate, they just go directly to San Francisco or down to New York because it's so much easier to get working visa there for O1, H1B, or EB1. And that's a kind of policy that the government could change. But just last week, they just changed a new startup visa program where all 42,000 applications in the Canada startup visa got declined. And then now they're capping it at 500 applications per year. I'm sure we have more than 500 promising founders in Canada in a year.
I mean, are there more ways that you think Canada, obviously, as you mentioned, that new policy, maybe not one of them, but are there more ways that maybe Canada could be more open to allowing people to, have tech startups stay in the country?
Yeah, I think funding is a big part. For example, when we incorporate in Delaware and we raised our round, we raised $4.5 million on a $25 million pose. And it's very easy to close that round. We close in a week versus in Canada, in Western Canada alone in Q1 2025, the entire province in pre-seed round in total raised $3 million.
That's a stunning figure. And is it one of those things where we've seen attempts at, I think it was BDC Canada and other places that are trying to kick off a venture ecosystem? But maybe the honest question would be, is San Francisco too far ahead? Andreessen Horowitz just raised $15 billion. So even if we raise 30 million or 300 million, does it even matter at this point? Is venture capital, unless you're adding billions to the conversation, can we even catch up in that respect?
I do believe we can. with the current economy. And I'm a big believer in if you want to do something, you could just go and do it. The real question here is the economy and how much the federal government is supporting young founders or even VC funds. BDC is the largest fund in Canada, but you have all the other micro funds that are supporting founders and really want to be there for first-time founder, but because they don't have enough cash, it's really hard for them. And the way they structure is really hard for them to match the terms of Sanfran or any other VC in America.
And one more on my part would be just for your business that you founded, proximity to data centers, basically the access to tokens and compute, I would imagine is an important part of the conversation for you and other founders in a similar field. With basically every startup being an AI startup of some capacity from where we are today, if you look at Y Combinator or any of the big feeder funds, is having data center compute capacity available at basically low cost per token, is that a potential vector of competitive advantage that Canada can offer that's untapped for us?
Yes, that's absolutely right. So we have our first two customers for pilots actually in Vancouver, AC North and Pact Buildings. And we see absolute appetite for this kind of support in terms of growing the ecosystem. Compute is a huge part, and especially with the amount of water and energy and capacity that Canada has. We have huge land. We have a lot of waters. We have cooler temperatures, so it's very good for data center. It's a huge industry that can grow if the government is willing to support, especially when it comes to data center energy management.
Yeah, Mai Trin, founder of Internet Backyard, she referred to the killing off of the startup visa program. One of the factors there were reports of fraud in that program, in which in some of the cases entrepreneurs were ripped off by consultants in Canada. Coming up, we're going to check out the ETF market with the president of Pacer ETFs. That's ahead. Time for the ETF report. We're joined now by Sean O'Hara, president of Pacer ETF. Sean, thanks very much indeed for joining us.
Yes, good morning. Thanks for having me.
Tell us a bit about your company. What kind of assets do you have in ETFs right now?
We have about $40 billion in assets under management. We started 10 years ago, so we're on a pretty good growth trajectory, and I think about 55 or 56 different ETFs at this point.
And are you just offering them in the US or any sold in Canada or issued in Canada?
We do not have anything on the Canadian exchange. However, we do have Canadians that buy our ETFs. As you know, they're allowed to purchase US listed products. Oh, yeah. And we do have a small usage platform based out of Dublin.
Oh, I see. That's for international clients or the one in Dublin?
Yes.
Okay.
Well, a little bit of both. I mean, there's a lot of people in the US who invest here from South America, Mexico, and places like that. And so it's sort of a dual accommodation thing there, some to satisfy those folks in markets like Miami, for example, and then the broader European opportunity.
Well, let's get into a couple of the products you have. This is an intriguing one. It's up about 44% in the past year. Symbol is PATN. That's the Pacer NASDAQ International Patent Leaders. That's an interesting concept. A lot of people saying that intellectual property is the most vital economic asset right now in the world.
Yeah, this is an ETF we developed sort of in tandem with the NASDAQ. So we have, a pretty robust partnership with them. We use their indexes in a lot of different ways. And we had gone to them and said, why don't you have a NASDAQ 100 for international? And they thought, well, wow, that's a really cool idea. And so we went through several iterations. What we tried to do initially was to say, like, let's find a U.S. company who has an international counterpart, if you will. So you say like Apple, Samsung, for example. And that really wasn't the correct path. And then they came back to us and said, what makes the NASDAQ is innovation. And what drives innovation is intellectual property and patents. Mm-hmm. And so they work with an organization, IPR, to identify the patent value of individual companies across the international spectrum. So we start with the NASDAQ, small and mid-cap international indexes, and then we apply that patent score, and we select 100 stocks with the highest patent value. And so for those, who've been talking about international investing, which has been, a pretty hot topic of late, This is dramatically and intentionally different than traditional broad-based international indexes. It has very little, if any, exposure to financials, as an example, although financials are about 20% of the benchmark. It has a very, very big overweight, as you would imagine, to technology. So if you want to invest internationally, one of the drawbacks of international investing has been that the broad indices earnings growth, because it's saddled with sort of these heavy industry financial companies, hasn't been very attractive. By taking it away from that sort of cap weighting and sector weighting approach and focusing on patent value, you're able to create a much more dynamic portfolio that are names that are going to have potentially better growth opportunities than just the broad-based international index names.
And yeah, I see Taiwan Semi's the biggest holding, according to the latest report I have. Then Tencent, the Chinese internet giant, and Samsung Electronics, and ASML, the Dutch chip technology company. I see Toyota is in there. And then you have a couple of three drug stocks, Novartis, Roche Holding, and AstraZeneca among the top 10.
Yes, and so that would be sort of, a pretty good look, right? You got the technology names, you got ASML, who's, their etching platform is basically second to none. And, these chip wars are going to continue, and there's going to be big demand there. You have a couple of healthcare companies that's mostly looking at their pipelines. And then Toyota is an interesting one because, they're also, beyond just a car manufacturer, they're also getting into robotics and things of that nature.
Let's get to your next one. It's the Pacer US Cash Cows 100 ETF, COWZ. What's the idea with this one?
Yeah, this one is sort of our take on quality or value. Traditional value has been really price to book and low price to book, and that sort of weds you to sort of the same heavy asset sectors like financials, utilities, real estate, and materials, for example. So we use free cash flow yield as a screen here. So we screen from the Russell 1000 index, the 100 companies with the highest free cash flow yield. And then we take those companies and we weight them by their free cash flow in dollars with a cap at 2%. We rebalance every 90 days. And for those who are thinking that we're going to move back into sort of a quality cycle, we've been in a very, very heavy momentum, low quality market for the last 2 years plus. So far out of the gate this year, and really for the last 90 days, Cows has outperformed the broad market, and if you measure it by the S&P 500, mostly because there's some skepticism, if you will, about valuations in the broad market. There's some skepticism that the hyperscalers who have committed to spend $3 to $5 trillion are actually going to monetize that. And so Cows gives you a high quality portfolio of 100 stocks that are profitable, that generate huge free cash flow. And over the life of the fund, we've beaten our value benchmark by around 300 basis points a year. So it's delivered quality returns consistently for investors. And in this environment, I think a little lean towards quality and profitability, given that the market has been so focused on momentum, and 7 names might be a good add-on in a portfolio.
It did lag the S&P 500 last year, a return of about 9%. So it didn't keep up with the market.
No, but as I said, the last 90 days, it's 600-700 basis points ahead of the broad market. So if it turns, and it will at some point, you'll see, that predominant pattern of Cows sort of moving forward when the broad market sort of, slows down a little bit.
And tell us about your last one. It's QDPL, Pacer Mataurus, U.S. large cap dividend multiplier.
Yeah, so this is sort of our answer to how do you get income from an equity portfolio. So traditionally, people would use a covered call strategy, for example, or they might buy high dividend paying stocks. The trade-off you make when you do those kinds of things to get income is you sort of cap your upside, if you will, specifically with covered call strategies, like something like a JEPI, for example. What we do is we sort of deconstruct the S&P 500 here. We put about 85 to 90% of the money in the S&P 500, and the remainder is used to enter into futures contracts for dividends, which is how we generate that extra income. So we're targeting an income stream of about 4 times the S&P's dividend in a portfolio that's really uncapped on the upside because it's mostly invested in the S&P 500. And so if you're thinking about getting income from your equity portfolio, those traditional ways might not necessarily provide the same sort of, 1-2 punch, if you will. You're not constraining the equity returns, but you're also getting a very, very high yield. And most of that yield is tax-free.
Why tax-free?
Because from a tax perspective, they treat the dividend futures component and the collateral that we use as a return of capital. You know, all dividends are basically return of capital, but if you get a normal dividend, the IRS decides they're going to tax that as a dividend. Here, because of the way the accounting works, we're able to sort of shift that burden. We continue to defer the taxes and classify some of the distributions as return of capital. So like last year, we made about 85% of the market's return on the equity side. We distributed around 5%, and I think 93% of it was tax-free.
Although my understanding, and we better caution viewers, talk to your own tax advisor whenever tax comes up, but a return of capital, I think, reduces your acquisition costs. So you can, in some cases, pay more in a capital gain when you sell it.
Not necessarily. If you hold it for your lifetime, you could get a stepped up in cost basis. But yes, at some point down the road, if you were to sell the ETF, you would pay tax on the undistributed gains.
No problem. And that one broadly matching the market last year, a total return of just over 16%, only slightly lagging the 18% return from the S&P 500. Fascinating stuff, Sean. Thank you very much indeed.
Thank you so much. Have a great day.
Sean O'Hara, president of Pacer ETFs. Coming up, we'll take a look at why the TSX equity listings keep getting smaller. There are more than 30% fewer companies than there were a decade ago. Canadian inflation year over year accelerated more than expected as of December. Data from StatsCan indicates that the Consumer Price Index was up 2.4% from a year earlier. Due to a tax holiday, though, at the end of 2024, the numbers are a little distorted because, of course, that pushed down the prices of goods such as kids' toys and alcohol at the end of 2024. Broader food prices rose more than 6% year over year, the most since 2023, while gasoline prices saw a decline year over year. Gold and silver hitting new record highs today amid an accelerated push by U.S. President Donald Trump to take over Greenland. And that is fueling fears of geopolitical uncertainty and a stepped-up trade war between the U.S. and Europe. Trump now says the U.S. will impose tariffs on European nations that oppose his plan to take over Greenland. European leaders are discussing options for how to respond, including retaliatory levies on U.S. goods. On a lackluster day for the broad market, Mullen Group issued a forecast for 2026 that exceeded expectations. The Canadian trucking and logistics firm is targeting up to $2.4 billion in revenue, driven by acquisitions, improving freight demand, and infrastructure spending. Mullen also says it can fund long-term growth, and it's focusing on robotics to improve warehouses and data management. There's a look at the TSX, pretty flat today after closing at a record high on Friday. Two themes, pervasive themes over the past couple of years for Canadian financial markets have been momentum in private capital and the impact it's had on the number of listed stocks. We've seen an endless parade of privatization deals. It feels like one a week, bringing stocks off the TSX. We're joined by Neil Self, founding principal at Infor Financial Group. Thanks very much for joining us.
Thanks for having me, Andrew. Good to see you.
And a pretty incredible statistic, in a decade, the number of stocks actually on the TSX down by about 35%.
Yeah, well, it's good to put Canada in the global context. In 2025, we actually saw a pretty decent rebound in global M&A. Deal volume globally was about 4.8 trillion, which was up about 30%. But when you look below that number, it's really quite nuanced. Deal counts were much more uneven, pretty well flat year over year. So the market's been defined by fewer deals, but larger, higher conviction deals, typically where there's strategic rationale. and financing was available to execute those transactions. The dominant driver has been corporate transformation, as we saw with the big tech Anglo deal here in Canada. Canada itself, though, outside of the banks and some of the larger specialty companies, is really full of mid-market companies, and those mid-market companies have been picked off. I think many of them are undervalued, have been overlooked, and what we've seen is that, as you mentioned, a whole host of Canadian companies over the last 10 years, but particularly over the last year, going private. We, as a firm, Infor Financial, advised on six go privates on the TSX, including Mubadala's acquisition of CI and Dentalcorp's acquisition of GTCR this year. And we expect that pace to continue into 2026.
Yeah, so CI going private, that was the biggest deal you did, I think. And it seems a bit depressing almost that Canadian companies just can't attract valuations, can't attract investors in many cases.
Yeah, I think depressing is one word to describe it. Certainly, we are not, as a nation, replacing companies that are going private with new IPOs. It's not solely a Canada issue. Private capital has grown by leaps and bounds over the last few years and represents a real viable alternative to public markets today. And we're seeing private capital providers, both equity and debt, not only focusing on Canadian acquisition opportunities, but focusing on global acquisition opportunities. We expect that to continue. Sponsor-backed activity is likely to pick up as they are under increasing pressure to deploy that capital, which means that companies will function more in the private. We'll see more companies functioning in the private market as opposed to the public market probably going forward.
And Jamie Dimon of JP Morgan has expressed concern over the drop in U.S. listed companies. Apparently, he said in 2023, the number of U.S. public companies had dropped from 7,300 in 1996 to just 4,300 more recently. And he says, in some ways, this is a loss of transparency because these companies have to report under rigid rules how they're doing.
Yeah, I think it's a good point, but candidly, I think too much is made of the regulatory complexity of being a public company. Perhaps governments around the world will lighten up on that, and that would be welcome. But I think the real driver is we're seeing private equity funds and private debt providers just have much more resources to go after public companies. And if you're a public company, it can grow just as well with a private company, private equity backer. Why would you stay public? You've got greater regulatory burden, greater reporting burden. You've got a whole host of shareholders who have opinions on how you run your business. And so I think the driving force globally is the growth in private capital. But there's no doubt that Canada is feeling the impact of go private transactions probably as much as any exchange in the world. And that's a result in large part of not replacing our IPO candidates either in the extraction industries, metals, or oil and gas. And even with AI, while we have a few national champions in AI, we just don't have as many up-and-coming tech and AI-related companies as you would find in the United States and perhaps elsewhere.
A couple, now I know these are not equity funds generally, but we have seen a couple of real estate and private bond funds halting redemptions in Canada.
Yes, I mean, certainly one of the issues that you have with funds that buy long-term assets, and it doesn't really matter where they're located, but have short-term redemptions is a mismatch. And certainly the Canadian real estate market has been very hard hit over the last couple of years, and real estate is extremely hard to sell in the Canadian market at what managers believe are fair prices. And so they have many Canadian real estate funds have halted redemptions to try to preserve long-term value.
Mm-hmm. We'd better jump. Thank you very much. It's a fascinating area. I really appreciate it. Neil Self, founding principal at Infor Financial Group. Coming up, hot picks in software. There has been a mixed performance for a lot of names in that industry over the past year and more. We're going to find out why our guest has Palo Alto, the cybersecurity expert, as her top pick. Hot picks. Today we are looking at software. Our guest has Palo Alto, the cybersecurity player, as her top idea. She says over the past few years, its stock performance has been uneven, but business has picked up, and she's giving Palo Alto the benefit of the doubt, given its history of being able to navigate short-term headwinds. We're joined by Fatima Boulani, Managing Director and Co-Head of Software Equity Research at Citi. Thank you very much indeed for joining us.
Thank you for having me, Andrew.
I think at one time people thought, well, Palo Alto, how could you miss with that stock? The virus threats, such a dangerous world out there in cybersecurity terms. But there has been some choppiness along the way.
Absolutely. So this is a name that we are absolutely recommending to our investors to put in their portfolios for 2026. The stock has had some lagging performance, but we do believe this is the year the stock can be off to the races. And there's really three elements that our view is grounded in. Number one, cybersecurity budgets are increasing. Now, I half joke that, when cybersecurity budgets those budgets start decreasing, then we have a problem. But budgets accelerating are actually an extremely positive dynamic. And based on the body of proprietary work that we've done, a lot of these budgetary pressures that are moving upward, which is positive for Palo Alto, a large part of that is being governed by AI and generative AI, and organizations very actively thinking about large-scale AI projects, but how am I going to wrap cybersecurity around these new frameworks and protocols and projects and applications that we're going to be deploying are going to be deployed in a large organization? So number one, budgets are going up because the impetus and imperative AI is going up. Relatedly, as AI goes up, the use of novel technology is going to go up, which means your risk of threats, your attack surface, the way bad actors and malicious actors can come into your organization, that can increase manifold. And Palo Alto has the de facto comprehensive portfolio around helping organizations and guiding them through and monetizing broad swaths of this in the process.
We're tight for time. Tell us about your next name, Rubrik. Just remind us what they do, please.
Rubrik is a company that provides backup and recovery solutions alongside cyber resilience capabilities. And really what that means is when organizations experienced an act of God, a natural disaster, maybe somebody in IT pressed the wrong button and brought the whole system down. But even more and more today, this notion of ransomware, where bad actors are holding organizational data hostage, you have to pay up to get your data back. In the construct of that environment, Rubrik has become so critical, so consequential, and just catapulted to the top of the list in terms of an area that you have to invest as data grows. And going back to the earlier point about the adoption of AI, just creating more areas of vulnerability and susceptibility for cybersecurity, that creates yet another opportunity. And Andrew, the overarching theme here is we are at the cusp of a generational shift in the way the average organization is going to think about their IT stack and their IT infrastructure, because they're all getting up and ready to do AI. So you have to modernize your infrastructure ahead of all of this. And both Palo Alto and Rubrik are the plumbing and infrastructure software componentry that are going to help make this happen in a secure way.
And finally, TEAM. Remind us who they are and why do you like them?
Atlassian is a platform of solutions that enables your workforce to collaborate in a more meaningful way. The solutions target developers, so your technical audience, your IT staff, and even folks on the business side. And really, this is a very interesting name for us, where we believe there is a massive dislocation in the valuation relative to what the state of the fundamentals are. There is a very, very acute fear that the rise of AI coding tools and code assistants are going to create a monetization overhang for this business, because this business does price its portfolio on seats or headcount. But we just do not think that's going to materialize, because at the end of the day, if more people are coding and more people are coding with ease, there is going to be massive productivity gains in the way software and applications are created. And that we think directly feeds into Atlassian's core competence around how do you manage this code? How do you debug this code? How do you enable people to collaborate around building applications in this new era of AI?
Thank you very much indeed. I really appreciate it.
Glad to be here.
Fatima Boulani, Managing Director and Co-Head of Software Equity Research at Citi. Coming up, we're going to check out a few movers on Bay Street today, including IAMGold. And let's have a look at the TSX. Closed at that record high at the end of last week. Oh, there you have it. Ring the bell. They have now pushed further into record territory. So the TSX at this stage set for a record high close, if it can hold on to these gains. One winning stock today has been IAMGold. The company came out with 2025 preliminary results and said its output is on track to top expectations, and production is expected to come in at just over 765,000 ounces. So that's more than 750,000 ounces. It says it saw strong quarterly output at all operations, including Côté Gold in northeastern Ontario. And Côté Gold, its production something like 280,000 ounces last year. So that's a pretty sizable mine. We also saw some weakness in Bitfarms today. That's the TSX. Oh, nothing dramatic. We'll have a look at Bitcoin in a second. But that company down, wow, is it ever volatile? Look at the spike there last fall, around the time that Bitcoin itself got to record highs. But can we have a quick look at, we'll have a look at Bitcoin later. It was down a little bit. Yeah, right now, my latest numbers have it down about 1%, thanks to Control Room, to just over 93,000. And finally, let's have a look at Mullen Transport. Investors like the look of the projections for 2026, or sorry, its projections beat expectations, according to Desjardins, but the stock not getting huge love right now. But of course, it is a fairly weak market. I know the TSX has edged up, but Mullen's saying that results are being boosted by acquisitions and investment in new technology, including robotics for the warehouses. And let's have a look at the gold price now, because gold has been hitting yet more record highs today. The spot price and the February futures not far short of 4,700. And let's have a look at oil, because oil was down a bit, as you might expect, with the prospect of higher U.S. tariffs. Oh, it's now holding its own. Oil did begin the day in North America, begin the trading session, losing a bit, but holding its own. Still below $60 US. Thanks very much for watching the Open Morning Markets. It's coming your way.